Hello and welcome to the full FX Unfiltered. This edition is in association with JP Morgan. My name is Colin Lambert, I'm publisher of the full FX, and I'm delighted to be joined by Scott Wacker, who is Global Head of E-commerce FICC Sales and Marketing at JP Morgan. Scott, lovely to see you again.
Nice to see you as well.
We are speaking just a week or so after the publication of the 9th JP Morgan E-Trading Edit. I've got plenty of things I found quite interesting in it, which I'm sure we'll get to. What were the sort of key themes and takeaways for you?
Well, what I find interesting is every time we run the survey, the feedback from the client is pretty consistent with actually what happens, right? So a couple things they highlighted was volatility, tariffs, access to liquidity. They talked about technology such as artificial intelligence being important, data, cost of execution. But it feels to me like, having run the survey towards the end of last year, like just after the U.S. elections, and then heading into, I guess the first 2 months of this quarter, a lot of the feedback seems to be coming through.
Yeah. I mean, I'd like to unpack quite a few of those themes as well, actually. But I guess it's important to sort of note that what we're talking about here is a survey taken in a period of high volatility, which is probably the number one concern for the traders out there that responded.
Yeah.
Okay, so let's look at it in terms of market access in these volatile markets. What stood out for you in terms of client concerns, and what did JP Morgan doing to actually help alleviate these concerns?
Yeah, so I think heading into the U.S. elections, we spent a lot of time with clients making sure that lines were in place, that we sort of talked to the customers about how they had been trading and what sort of access they were looking for across different asset classes. FX being, certainly the biggest asset class on the electronic channels and the pressure valve for almost everything. There was a lot of prep work going into the elections. I know the day itself was quite volatile, and we had a pretty seamless day, which is great. So I think it's a combination of making sure that lines are in place, what the clients need. From a technology perspective, that we're locked down, we're not making changes that could cause a disruption. And then just really being prepared to provide liquidity as and where it's needed by our customers. And this is a customer base that has continued to grow every year, really since we started building our electronic offering.
Yeah, and it's interesting. I found in the survey that liquidity availability was a lower concern than previous years. Market access was maybe a higher concern. It kind of told me that the LPs, JP Morgan, have got their ducks in a row in terms of their offering, and it's more about actually how you can help your clients get to market.
So I think that's right. Like I said, electronic trading has grown a lot. I think actually post-COVID, the availability of, say, liquidity or electronic channels has improved quite a bit. You have a number of market makers there. I think the fungibility liquidity is quite good. And like I said, if you've done your homework ahead of time, both on the client side looking at the liquidity providers and liquidity providers looking at their customers, if everything's lined up, then I think access to liquidity or the amount of liquidity is probably less of a concern, because we've sort of been through a bit of a battle test through the COVID years, and there was some volatility there, and there was some massive dislocations. We're certainly in a very volatile period since the U.S. elections, and seems to be heating up even more this year. So I think access to liquidity is fine. I think the real question, though, is quality of liquidity. And so I think this is really a function of how many players are looking to get more and more involved in electronic trading. And so that's not just banks such as JP Morgan wanting to provide electronic liquidity to their customers through channels, but it's also massive growth on the hedge fund side, obviously taking advantage of market dislocations and opportunities to make money. A huge growth in systematic accounts, looking to access various components of the fixed income, currency, and commodity market electronically, either over single dealer platforms, multi-dealer, or mostly APIs. I think direct connectivity has really grown. But I think one of the things we have focused on is not just providing liquidity, but also safeguarding the liquidity in such a way that we're providing liquidity to those that actually use liquidity in a very constructive fashion.
Yeah. And then there's a further complication. I would imagine you went through some client segments there. They're all going to access or want a different type of liquidity at various times.
Yeah. So, I mean, it is interesting because it's almost like a domino effect, right? And so, we're talking about FX today, but, the trend of electronification across the OTC asset classes, is continuing. And so what's happening is, very active traders in the markets that are already very electronified, pushing components that are maybe less electronic. FX options for one has become very electronic. I think, applying systematic models to FX options, FX swaps and forwards, we've seen massive growth there. The NDF construct as well, so moving away from the G10 currencies, looking for opportunities in other markets. And this has brought in access to markets that are perhaps wrapped in a different fashion. So rather than OTC, you've got futures wrappers, you've got ETF wrappers, and how you can sort of break those down and change those.
And these cannot be done efficiently without the technology, can they?
I think technology helps a lot in terms of creating that fungibility of liquidity across those different channels.
You mentioned AI earlier. I found it interesting that it's still a hot topic in the market. And I realise neither of us are AI experts. We'll make that disclaimer now. But it struck me that there's still a high level of interest from the edit in terms of AI and machine learning. But I'm not sure actually people are really deploying it in markets yet. Would that be your sense?
Yeah, so we asked the question as in what technologies do you think are going to be most important going forward?
Yeah.
And AI always comes up because there's a belief that AI is going to replace a lot of activity that's done by human beings.
Yeah.
My experience, and again, it's just my experience, is that actually AI is an enabler. Okay, what it does is it helps people do things better, right? Whether that's writing a presentation, coding new programs, looking for ways of optimizing models, for instance. So I see it more as a tool. I don't see AI yet making decisions, i.e. trading, making markets, etc. But AI, it just helps our automated trading teams, our digital market developers to just build better client-facing or internal-facing products. And optimizing these.
And it's interesting because I think JP Morgan's got a history of developing internal products that suddenly become very useful to clients and get rolled out.
I think that's our objective, really. It's funny because when we look at, call it market structure changes, right? So think of various platforms and the cost of execution, brokerage fees, data costs, et cetera. If you let those stay within the hands of one or a few players, then obviously you end up seeing somewhat oligopolistic or monopolistic tendencies in terms of price. Especially as electronic trading grows, the demand for data, the ability to run analytics or to build models grows. So we have to constantly think of ways of delivering more efficient tools or more efficient access to data. We do build things constantly, both for ourselves and our customers, and we're constantly looking for ways to make sure that the market is becoming more efficient.
And I found that, we're now about to get into one of my sweet spots or bugbears, you can make your own mind up, but there's obviously a lot of interest at the moment in single dealer platforms. I thought it was a very positive report for single dealer platforms, but still the overriding thing for me was people use both single and multi-dealer platforms. So information leakage became a very high issue here, and there's also a very high satisfaction with analytics. Is this really the single dealer platform sweet spot in terms of execution?
It's interesting because there's multi-dealer platforms, there's single dealer platforms, and there's direct connectivity. Right? So direct APIs into EMSs. And like with the growth of the systematic accounts and a lot of the hedge funds, like they prefer direct connections. And we can deliver data, information, and tools through APIs as much as we can through our own single dealer portal. On the multi-dealer space, you're a bit sort of chained to what the priorities of that platform is and what they can develop for the broader suppliers of the products or liquidity on those platforms. But it is absolutely true that you're probably going to get the most advanced and most sophisticated tools and capabilities on a single dealer portal. You'll have access to data, for instance, that you wouldn't have access to on a third-party platform, for instance. And also, if you think about some of the execution protocols, as you go from RFQ to click-to-trade to orders to algos, using algos has a lot of tweaks and nuances and features to it, which we try to deploy on multi-dealer and API, but it's always most easily deployable in our single dealer. And when I think about our single dealer platform, based on the third-party consulting firms that we use, I think we still have the biggest number of users. We still do more volume than anyone else on it, which I think bodes well to the products that we keep deploying. And I think there was a trend certainly when clients were starting to move off of it, more for desktop real estate than anything else. But to your point, I think with the growth in algorithmic execution, I think with the desire to have better analytics and visibility over what's going on, I think the single dealer portals have a lot to offer. Plus, we're going cross-asset as well. So a lot of the things that we've developed for FX, we are moving into other asset classes like government bond trading, interest rate swap trading, corporate credit, et cetera.
And that's something actually I wanted to ask you. We're talking about the edit being across multiple asset classes, and that's grown itself over the last 9 years. Do the results published, are they largely reflected in the FX market? There was no big outliers from FX in the edit this year. So I can look at, for instance, single dealer platform usage, I think is about 28%, took it as their primary channel. That would be for FX as well as it would be for other asset classes.
I think the 22% would probably be cross-asset. If we broke out FX, it'd probably be closer to a third.
Okay.
But no, FX is a huge component of our electronic offering. I mean, massive. Right?
So generally speaking, the edit did reflect. I mean, obviously, someone who should look beyond FX but rarely does, I can actually look at it and go, okay, well, that is what the results were for FX pretty much.
Yes.
Yeah. Okay. The other question I wanted to ask on that one as well is, did you see any variations around the regions? Because obviously, there's highly sophisticated clients in every segment, but are there regional variations emerging for you?
In terms of single dealer versus?
In terms of how actually what people's concerns are, and in terms of the execution protocols and breadth of offering that they require.
So when we look at the regional breakdowns, there's definitely differences in terms of how clients are organized and operate, right? So North America, you have very large asset managers, hedge funds, corporates, et cetera, that tend to be more siloed in terms of product specialization. In Europe, you have a much bigger sort of cross-regional aspect to it. So rather than being sort of a homogeneous North American market, you have Europe, UK, and all of CEMEA. And therefore, because of all the regional aspects, you see a little bit more cross-asset focus. And in Asia, most of the trading is more on the emerging market side. So there is obviously G10 rates and G10 FX, but most of the activity is around sort of Asian currencies, et cetera. So as a result, I think different products are important. So the NDF product in Asia is super important because that's where most of the business gets done. Obviously, Japanese yen, Aussie dollars are big as well as CNH, which is actually the largest currency we trade. In Europe, CNH is still very important, but you start to see the euro being very important. We actually see very heavy single dealer usage in Europe versus the other two regions. And I think a lot of that has to do with many of the big global macro hedge funds and systematic accounts tend to be, currency-focused funds tend to be either out of Europe or out of the UK.
Yeah.
And if you are actively trading and you're looking for good liquidity, good execution, algorithmic execution is probably the best way to get large transactions done very quickly or slowly, depending on what you're trying to achieve. North America, like I said, is more product specialists. I think we see more click-to-trade activity there. I think some of the multi-dealer platforms and some of the API usage is probably more prevalent there.
Yeah, and I guess to go back to the macro funds, a lot of the time these guys could be trading in decent size, which brings us to that information leakage find in the edit, which is actually people were more and more concerned about that.
Yeah, so leakage is important because it is really about preserving the franchise liquidity for the clients that need to be able to trade in size without obviously their activity moving the market either against them or having huge markouts. And when we think about leakage, there's really two aspects to it. There's reposting of access that are coming from our franchise, and we don't really want to do that if we can avoid it, because obviously that signals the market what people are doing. And then there's also the alpha generating side. So if we're showing our access to counterparts who are using that to build their trading models and therefore are trading against our axes, that doesn't help us recycle risk. That actually moves the market against us. So liquidity leakage and information leakage is very, very important. Yeah. And like I said earlier, with the growth in electronic trading and the desire for systematic accounts, regional banks, and hedge funds all trading more and more actively, keeping a lid on that is super important, particularly for the most active counterparts.
Yeah, it's a very complex issue, isn't it?
Yeah.
Yeah, glad it's not one I'm responsible for anyway. To close out, Scott, actually, just to pick up on something you said there, I'm going to try and pin you down on the last question. Where would you see the growth opportunities in e-trading, having studied the edit?
Well, edit or not, I know the areas that we're focusing on, right? A lot of it is just continuing to expand our product suite. So I think, first of all, on the NDF side, we were actually kind of surprised by how actively the market embraced NDF electronic liquidity, and more importantly, NDF algorithmic order execution. That has been stunning. And it kind of makes sense because have a systematic, sometimes passive approach to markets, knowing exactly where the pockets of liquidity are, and having a tool focused on accessing liquidity in a very careful way, it makes sense. But we were actually really surprised at how significant that has become. So we want to continue to fill out the capabilities across all the NDF activities that we have. Second of all, I think FX options. Again, it's more fleshing out what we already have, both in terms of structuring tools. There's a big demand for structuring tools, but also the ability to deploy systematic strategies on FX Vol, which means streaming liquidity mainly through APIs and getting better at that. Same concepts apply in FX Vol as they do in FX Cash in terms of making sure that we're able to determine who's using the liquidity in ways that doesn't jeopardize our franchise. Data and analytics, we talked about that. So TCA, pre-trade, trade, post-trade analytics is very, very important. Some of that comes down to data and where the data is. We've noticed that data costs continue to go up. So the question is, how are you going to execute? How are you going to analyze the data? I don't think there's a perfect solution out there, because not all the data goes into one place. But data analytics on the back of business that you do is super important. And we're looking at that cross-asset, so that's very important. Another thing which I think is interesting is moving away from the large institutional players, more the regional corporates, and let's say more the business management side of institutional accounts, is payments. So, payment platforms, payment capabilities are quite prevalent, But again, as markets become more electronic, clients are starting to want to be more engaged in that payment activity. And so we're developing sort of quasi-active currency payment tools, platforms. Okay. So that's a big focus for us going forward. Other than that, it's continue to find ways to communicate with clients about how they're using liquidity to make sure that they're getting the best liquidity that they can get at any given moment. There's an active dialogue between ourselves and our customers as we come across situations where clients may be leaking information to the market, more than likely are unaware of it. And so we just work with the customers to figure out how to enhance that.
I mean, it's great to hear all these things because obviously it just tells me I'm going to have another busy year, right, about this stuff. But I guess, the bottom line for me is I look at it and think 4,200 plus traders giving you their thoughts really does help sort of formulate some opinion. Scott, thank you very much for your time today, sharing those thoughts with us. Fascinating as ever. And hopefully we can do this again soon.
Great to see you. Thanks.
And thanks everyone for watching, and we'll be back again very soon.